need a few more minutes.
I am back.
All right.
I saw a thumbs up from Tabisa. She's back too.
Okay, perfect. So in learning lecture example, in lecture example number 4, we have another compound financial instrument, which we need to classify. So they are convertible preference shares. The preference shares are convertible at the option of the holder in 5 years into 100,000 ordinary shares. So we know that if they're at the option of the holder, it means that in 5 years' time, if the holder comes and says, actually, I want cash instead, it'll be the equivalent of the holder holding a gun against us, the CA Limited, to say, I want cash, you have no obligation, you cannot avoid transferring cash, which means the convertible preference shares have a financial liability element to them. On the other hand, they can, if the holder comes and says, I want 100,000 ordinary shares instead, this is a fixed number of ordinary shares, we will have to issue the number of ordinary shares. In this case, we have a compound financial instrument because there's the portion of the agreement that is a financial liability because the holder can come and request money from us. On the other hand, they can come and request shares. If the shares are not converted into ordinary shares, the entity will redeem them at their par value. So we know we have a fixed amount that we're going to have to be settling. Dividends on the shares are payable annually on the reporting date, and CA Limited doesn't have any discretion with regards to the declaration of the dividends. In us discussing the appropriate treatment at the end of 5 years, the conversion will be at the discretion of the holder. Should the holder elect to receive payment instead of ordinary shares, CA Limited, the company, will have no realistic alternative to avoid making payment to the holder of the convertible preference shares. They won't be able to avoid making payment. Therefore, CA Limited has a financial liability to settle in cash as a result of entering into the contract that issued the convertible preference shares. Should the holders elect to receive ordinary shares instead, then CA Limited will have to issue these to the holders. Given as well that CA Limited doesn't have discretion with regards to the declaration of dividends that are payable annually on the reporting date, this means that CA Limited has an obligation to deliver cash to the holders of the convertible preference shares in the form of dividends. So there is an obligation to pay dividends. There's also an obligation to pay the par value at the end of the 5 years. But there's also the element where the holder can elect to receive shares instead. So therefore, the convertible preference shares are a compound financial instrument that contains a contractual obligation to deliver cash, the contractual obligation being the dividends that CA Limited has no discretion over the declaration of, as well as the settlement amount. And the financial instrument also contains CA Limited's own equity instruments that will be issued in the instance that the holder elects to receive 100,000 shares. Therefore, CA Limited should separate the initial carrying amount into its financial liability and its equity components. Now, to Tabisa's question, I want us to skip over to lecture example number 10. We are going to get to it later on at a later stage, but I think for purposes of completing the thought process surrounding compound financial instruments, I want us to look at how the numbers would look. Please confirm that what you're seeing is lecture example number 10, compound financial instrument.
Yes.
Great. Lecture example number 10 says to us, CA Limited is a company with a financial year end of 31 December. On the 1st of January 2021, CA Limited issued convertible debentures at their par value of 1.2 million. That means that CA Limited received 1,200,000 Rand in exchange for issuing convertible debentures. The debentures pay coupons at an annual rate of 11%. This 11% is 11% of the par value, and the par value is 1.2 million, meaning year on year, the debentures CA Limited will have to pay a coupon of 11% of 1.2 million. The debentures are convertible at the option of the holder on the 31st of December 2024. And they're convertible at either their par value or for a fixed number of ordinary shares in CA Limited. One, because they're convertible at the option of the holder, it means that at the end of 2024, if the holder comes and says, I want cash, CA Limited will have no alternative other than to pay cash. So they will be forced to pay cash because of this agreement that they've entered into on the 1st of January. So on the 1st of January, they already have a present obligation to deliver cash. In the event that in 4 years' time, or in the scenario where in 4 years' time the holder elects to receive cash, if the holder does not elect to receive cash, they will issue a fixed number of ordinary shares. In the last sentence of the scenario, or the second last sentence rather, it says the market-related interest rate on debentures with a similar risk profile and no conversion option was 14% per annum. The financial liability is carried at amortized cost. In us now separating, or before we go into the separation, are you comfortable with the fact that there is a financial liability and an equity component in this instance?
Yes, I am.
The financial liability is the obligation to deliver cash at the end of the 3 years, or 4 years rather.
4 years.
Yes. As well as to pay the coupons of 11% per annum. That's the financial liability. But in substance, there's also the likelihood that the holder may choose shares instead, a fixed number of shares instead. And because they can choose a fixed number of shares, we need to reflect this on the 1st of January 2021. We need to reflect that there is an option for the holder to also receive a fixed number of shares. The required says to us, we need to process all of the necessary journal entries for the year ended 31 December 2021. So on the 1st of January 2021, the first thing we need to say is how many periods are there? If the year end is 31 December, it means 1st January 2021 to 31 December 2021 is 1 year. Then 31 December 2022 is the second year. 31 December 2023 is the third year. 31 December 2024, the fourth year. So in 4 years' time, we may have to, as CA Limited, we may have to pay the par value as a conversion or as a settlement or redemption of these debentures. If we don't pay the par value, we're going to have to issue a fixed number of ordinary shares. This is how you go about doing it. Step one. In step one, you first have to calculate the fair value of the liability component using the market-related interest on debentures that have a similar risk profile with no conversion option. In our financial calculator, N is the number of periods. We have 4 years. And why do we say 4? We say 4 because the coupon payments are paid annually. And the coupon payments are 11% of the par value. Our par value is 1.2 million. So to get to the payments, so we're going to have 4 payments. We're going to pay payments over 4 financial years. At the end of each year, we're going to have a payment. So we're going to have 4 payments, and that is represented by the N in our financial calculator. The payment will be 11% of 1.2 million, 11% of the par value. We were told that the debentures pay coupons at an annual rate of 11%. So 11% multiplied by the par value of 1.2 million. That gives us 132,000. The future value is what we are going to pay at the end of 4 years if the holder of the debentures chooses to receive cash. And in the scenario, we were told that the debentures are convertible at the option of the holder on 31 December 2024, meaning in 4 years' time, at either their par value, and we know the par value is 1.2 million. So in 4 years' time, we may have to pay a future value of 1.2 million. What interest rate are we using? We have to use an interest rate for a financial liability that has a similar risk profile, but without a conversion option. So we're going to use an interest rate of 14% to determine the present value. The present value being PV is the fair value of the financial liability or the liability component. And that gives us an amount of 1,095,000. What we know is that on the 1st of January 2021, what went into the bank account is 1.2 million. That is the carrying amount of the financial instrument as a whole. When you subtract the financial liability of 1,095,000 from it, what is left is the equity component, and that is 104,893 rand and 64 cents. Any questions so far? Tabisa,
No, I'm fine, David.
are you 100% comfortable with how we got to the numbers?
Yes, I'm 100% comfortable.
Oguhle, are you comfortable?
Yes, I am, sir.
So just to confirm the inputs, right? In terms of determining the inputs, we chose 4 as the number of periods because it coincides with the number of times that we are going to make payments. So over the 4-year period, we are going to make 4 payments, and the payments will be 11% of the par value, being 132,000. The future value, the scenario said the future value will be the par value. If we were told that the debentures are convertible at either a different amount, if we were given a fair value or whatever, if the amount that we were going to pay was, say, 1.6 million, the future value here would have been 1.6 million. The interest rate would have still remained 14%, because 14% is an interest rate that is applicable to a liability component that has a similar risk profile, but without a conversion option. The present value would then be what represents our fair value of the liability component. That fair value then is what we subtract from the carrying amount of the financial instrument to give us the equity component. So on the 1st of January, in us preparing our journal entries, we would debit the bank account with the 1.2 million that the debenture holder paid. We would then credit debenture liability in the statement of financial position with 1,095,000, and the remainder would be our equity component. The scenario told us that the financial liability is carried at amortized cost. What this means for us is that from the 1st of January 2021 up until the 31st of December 2021, the financial liability would accumulate interest, and interest would be accumulated at that 14%. So we would have to debit interest expense and credit the debenture liability, increase the carrying amount of the debenture liability was 14% of the opening balance being 1,095,000. So if you take 1,095,000 being the fair value and you multiply it by 14% for the entire year, it gives you 153,314. That is the amount by which our debenture liability would increase over the year. That's why we then credit the debenture liability component and we debit interest expense in our statement of profit or loss. Then at the end of the year, we would have to account for that payment, the payment being 11% of the par value. In us accounting for the payment, we would credit the bank account and debit the debenture liability for the coupon payment. The equity component, equity is never remeasured. ladies and gentlemen. So the equity component will just stay as 104,893 up until the end of the debenture period. Any questions? No questions. All right. Let's now go back to our discussions surrounding classification. We had covered lecture example number 4, and we therefore now need to move over to the recognition of interest, dividends, etc. Please, will you kindly confirm that it is the solution of lecture example number 4 that is appearing on your side?
Yes, it is.
Thank you so much. So how do we recognize interest, dividends, losses, and gains? The standard is very simple and straightforward with regards to these. What the standard says to us is that if you have any interest, any dividends, any losses, and any gains relating to a financial instrument or a component that is a financial liability, then these components of interest, dividends, losses, and gains will have to go to profit or loss. We saw that just now where we said the financial liability attracts interest. The interest goes to the statement of profit or loss. We basically just followed this instruction from the standard. Any dividends that are paid from a financial liability will go through profit or loss. Any losses or gains when we derecognize or remeasure financial liability will have to go through profit or loss. The second bullet point says the classification of a financial instrument as a financial liability or an equity instrument determines whether interest, dividends, losses, or gains relating to that instrument are recognized as income or an expense in profit or loss. For instance, any distributions to holders of an equity instrument will be recognized directly in equity. And you have seen this happen time and time again, ladies and gentlemen. When an entity declares dividends on ordinary shares, the accounting treatment there is debit dividends declared in equity, not in profit or loss, and then credit dividends on ordinary shares payable or liability. If there are dividends that are declared on preference shares and the preference shares are equity, then the debit entry is dividends declared on preference shares in equity, credit dividends declared payable, a liability. So the distribution to a holder of an equity instrument goes directly into equity, doesn't go into P&L. The standard then tells us as well that changes in the fair value of an equity instrument are not recognized in the financial statement. So quite like we saw in example 10 just now, once we've determined the equity component, it stays as is. We never have to remeasure it. Equity is never remeasured. Any gains or losses that relate to changes in the carrying amount of a financial liability are recognized as income or expenses in profit or loss, even when they relate to an instrument that includes an equity component. So if there are any changes to the carrying amount of a financial liability, these changes have to go through profit or loss, quite like what we saw when the compound financial instruments financial liability component accumulated interest. The interest increased the carrying amount of the financial liability, i.e., it caused there to be a change in the carrying amount of a financial liability. The increase in the financial liability went against interest expense in profit or loss. So this slide here is what we have been doing in the accounting treatment all along. But one important thing to remember is that when there are distributions that are made to holders of equity instruments, these distributions do not touch P&L. They go directly against equity. The transaction costs as well of an equity transaction have to be accounted for as a deduction from equity. So if you classify a component of a financial instrument as equity, any transaction costs related to it go into equity. Any distributions on that instrument go into equity. If you are classify a component of a financial instrument as a financial liability, the transaction costs attached to that financial liability component go through profit or loss. Any changes in the value of that financial liability also go through profit or loss. And if there are transaction costs that relate to the issue of a compound financial instrument, you will have to allocate those transaction costs on a proportionate basis. So meaning you will have to do a proportional calculation of sorts and allocate the transaction cost to the equity component as well as the financial liability component. But this is beyond the scope of your syllabus in the CIMA course. Just know this as the backdrop of the knowledge background of the theory. Now coming to offsetting of financial assets and financial liabilities. So what the standard tells us is that a financial asset and a financial liability shall be offset and the net amount presented in the statement of financial position when and only when an entity currently has a legally enforceable right to set off the recognized amounts and the entity intends to settle on a net basis, or the entity intends to realize the asset and the liability simultaneously. What this means is there can be instances where you as an entity owe money to another entity, and that entity also owes you money. So for argument's sake, let us say I am an entity, I'm David Limited, you are CA Limited. You as CA Limited owe me 100 Rand, and I owe you 200 Rand. In your financial statements, you would recognize a financial asset because you have a contractual right to receive cash from me, and that financial asset would be 200 Rand. On the other hand, you would also have to recognize a financial liability, which reflects the fact that you owe me 100 Rand. The standard says, when you are now presenting your statement of financial position, truth is you are owed an amount by the same entity that you owe an amount to. You are allowed to show the net of these amounts only if you have a legally enforceable right to set these amounts off. So between the two of us, we would have to have a clause in the agreement that gave rise to the financial asset in your books, as well as in the agreement that gave rise to a financial liability in your books. Those two agreements should have a clause or clauses that say these can be settled on a net basis. That's the first criterion. The second criterion is that we should have an intention to settle on a net basis, or the intention should be that you're going to realize the asset, meaning before you can settle the 100 Rand, I have to pay you the 200. If you meet these set of criteria, then you are allowed to go on the statement of financial position and present the net of the two amounts. Any questions? No questions. Tabitha, are you covered? I cannot see the chat box, so I do not know what's in the chat box currently, ladies and gentlemen.
Yes, I'm covered.
All right, thank you. Ogusha, are you covered?
All is well on my side. Covered.
Happiness. Thank you so much for the feedback, guys. Now coming to the disclosure of financial instruments. When we come to the disclosures are found in the notes to the financial statements. And for each and every category of financial instrument, be it a financial asset, financial liability, or an equity instrument, you will have note disclosures. And for demonstration purposes, we've included the disclosure for the same set of financial instruments pertaining to Shoprite. We've included note disclosures for stated capital, as well as for treasury shares. And this is just to complete your understanding, to say in the disclosures, you would find that there are, for stated capital, there's a number of authorized ordinary shares, a number of issued ordinary shares, as well as the values of these in the tables and narrative disclosures. Then for treasury shares, we would have an X amount of ordinary shares that are treasury shares. And by treasury shares, we refer to shares that have been bought back from shareholders by the company to just hold them and reduce the number of issued shares out in the market. And here is a reconciliation of sorts to say at the beginning of the year, there was a balance of 43,164,607 treasury shares purchased during the year, and ultimately bringing us to the balance at the end of the year, and then a breakdown of what that balance consists of. Again, coming to an illustration of our statement of financial position, we have touched on what would be our non-current assets, what would sit in our current assets, and also what would sit in our liabilities, be it non-current liabilities and current assets. You would have your trade and other receivables under current liability, trade and other payables, pardon me, trade and other payables under current liabilities, borrowings being your current portion of your borrowings, and bank overdrafts that are sitting as current liabilities. Now, having set the context insofar as disclosures and presentation in the statements, let's talk about the recognition, the classification, as well as the measurement of financial instruments in accordance with IFRS 9. What we've covered so far, just to recap, is we've covered the definitions of what an equity instrument is, what a financial asset is, what a financial liability is, as well as what an equity instrument is, along with the definition of a derivative financial instrument. We then went on to say, fine, having understood these definitions, let's go into IAS 32 to talk through instances where we distinguish between equity, or what's an equity instrument versus what is a financial liability. That's where we did the classifications and separation of a compound financial instrument into its equity component and its liability component. Just now, we then just covered a bit of the disclosures that you would expect to see in the financial statements. We then came back in the previous slides to say, coming back to the bigger picture being our statement of financial position, we have non-current assets, we have current assets, we have liabilities that are broken down into current and non-current liabilities. Now, we are coming into talking through the recognition of financial instruments, the classification of our different financial instruments, as well as the measurement thereof. And this is all stemming from IFRS 9. What we were covering, being the classification of equity versus liabilities, was coming from IAS 32. IFRS 9 has an objective. The objective is to establish the principles for the financial reporting of financial assets and financial liabilities that will be present, or that will present rather, relevant and useful information to users of financial statements for the assessment of the amounts, where we talk measurement, the timing, where we talk classification as current versus non-current, and the uncertainty of an entity's future cash flows. Starting with, we're going to begin with financial assets. When we talk about financial assets, ladies and gentlemen, we are talking about contractual rights to receive cash. We're talking about cash itself, or contractual rights to exchange cash or other financial instruments under conditions that are potentially favorable to the entity. Having established that a contract gives rise to a financial asset, we have to then subsequently, or classify it as subsequently being measured at either amortized costs, at fair value through profit or loss, or at fair value through other comprehensive income, mandatorily, or by having elected to measure the financial asset at fair value through other comprehensive income. The classification of these financial assets is often, and here when we talk financial assets classification, it's important for us to distinguish between financial assets that are equity of another entity, i.e., investments in shares, versus financial assets that are debt instruments. And when we talk particularly about financial assets that are debt instruments, meaning financial assets that are not shares in other entities or shares of other entities, when we look at those, their classification is based on the basis of two things. The first is the entity's business model for managing the financial assets. That is to say, what is the entity? Why is the entity holding the financial asset? Is the entity holding the financial asset? And the financial asset could be a debenture that the entity has purchased. It could be a financial asset in the form of a loan that has been given to another entity. Question becomes, why is the entity entering into this financial instrument? Is the business model having an objective that is to hold the financial asset in order to collect the contractual cash flows? Or is the entity holding this financial asset to sell the financial assets within the short-term period to realize short-term gains? Or is the business model to collect contractual cash flows and also sell these financial assets? That's the first portion of it, to say, what is the business model? The second is to say, what are the cash flow characteristics of these financial assets? That is to say, are the contractual terms of the financial asset giving rise to specific payments on specified dates? And are these payments compensating the holder for the time value of money and the credit risk associated with the financial asset? For an example, if you are a company and you give me a loan and the loan bears interest, the interest that you would be charging me would in almost every instance be interest that compensates you for the amount of time, the length of time it's going to take me to pay you. So if we have entered into a loan for, say, 10 years, the interest component that you're charging me would be to compensate you for the length of time being the 10 years over which I have to pay you back the money, number one. Number two, the interest rate that you charge me would take into account my credit risk. What kind of debtor am I? Am I a high risk debtor? Am I a low risk debtor? What's my credit score looking like? So in that instance, the payments that I would make on a regular basis would be specified by the contract to say, you will pay X amount monthly or you will pay X amount annually. And that payment that I pay you would cover the interest and the capital component of the debt. These payments that I would be paying you would in all likelihood be payments that settle the principal amount, being the capital portion of the debt, as well as interest that is accruing on the principal amount outstanding. So the nature of the contractual cash flows is what we would need to look at when we determine the classification of this loan. We'd also have to look at the reason why you've given me a loan. Are you entering into a loan to collect these contractual cash flows from day naught up until the end of the 10 years? Or are you entering into this loan so you can sell it over to a debt collection company? Or are you entering into this loan to collect the contractual cash flows and perhaps consider selling the loan over to a debt collection agency? So when we talk about business model, we talk about the objective behind entering into the agreement. And when we talk about contractual cash flows or their characteristics, we talk about what the contractual cash flows are for. These coupon payments that are paid in the debenture, are they to compensate you for the time period of money, yes, the time value of money, which reflects the period of time over which the payments are made, as well as the credit risk, or are they compensating you for something other than that? Any questions so far? Are we all clear, ladies and gentlemen?
So far, so good from my side.
Happiness.
Tabisa?
Tabisa, are you covered?
Yes, guys.
Great. So when we talk about business model as discussed now, we refer to how an entity is managing its financial assets in order to generate cash flow. So is the entity looking to realize cash flows from those payments, or is the business looking to realize cash flows through the sale of these financial assets, or is the business looking to generate both cash flows from, or is the entity looking to generate cash flows from both the servicing by debtors of these debts as well as the sale? Because remember this, guys, think of banks. If you take out a loan, maybe for vehicle financing or for whatever, you owe the bank money, therefore the bank recognizes the financial asset. The bank can decide to say, here's a portfolio of 3 customers who've all taken out loans for vehicles. One of them is Obushe, the other is Tabisa, the other is David. Here's the portfolio, it's sitting here. Why are we holding all of these financial assets? Are we looking to collect the contractual cash flows, or can we sell this portfolio over to someone else who will collect the contractual cash flows, and we just get into the contract to sell it off? Or are we going to try and collect the contractual cash flows and see when we then need higher cash flows, we can then sell the debtors book over to another agency? So that is the business model that the bank would look at. And based off of the business model, the classification of the financial assets will follow. And this business model will be determined at a level that reflects how groups of financial assets are managed. And a group of financial assets here for our purposes would be all of the vehicle finance loans that are taken out. So it would be determined, the business model will be determined at a level that reflects how this group of financial assets is managed together to achieve a particular business objective, be it to collect the contractual cash flows over the finance period, or to collect the contractual cash flows and perhaps sell, or purely to enter into the agreements and then sell them off to a debt collection agency. Now, the model does not depend on management's intentions for one instrument. It is determined on a group level. This condition is not an instrument by instrument approach to classification. So as an entity, as a single entity, you may have more than one business model. You may have a group of loans that you're holding to collect contractual cash flows, and another group that you're holding to sell off in the short term, and another group that you're holding for both collecting contractual cash flows and selling these. So a business model is a matter of fact and not merely an assertion or a declaration, and the assessment is not determined by a single factor or activity. So whether a third party imposes the requirement to sell the financial asset or the activity is at the entity's discretion is not relevant. For instance, if we are holding a group of loans, or the bank is holding a group of loans to collect contractual cash flows, and a third party imposes legally, goes to the courts and says, the bank owes me X amount, and I know the bank has financial assets amounting to 10 million. The bank should sell these financial assets to a debt collection agency to settle the loan that it owes me. And the court grants this order. The fact that the court has granted the order for this group of financial assets to be sold does not change the business model at all. The business model still remains that the entity had entered into this business model, or the entity was holding these financial assets for purposes of collecting the contractual cash flows. So in determining the business model, it's necessary to consider the frequency of sales, the value of sales, and the timing of sales. If a portfolio of financial assets has a high frequency of sales, and the reasons for it are seeming to indicate that the entity is now holding these financial assets to sell them in the short term, then that would mean that the business model is to sell these financial assets. And it's a common thing in the market. I know that Many students struggle with the idea of having a financial asset in the form of a loan and selling it. There are entities such as debt collection agencies that actually buy these books, debtors' books, to collect the contractual cash flow. So if I, for instance, am owing you money as part of a portfolio of debtors that you have, you could sell it off to someone else and you get the money today instead of having to wait for 5 years while I make part payments towards the loan. And so irrespective of the frequency and value, sales due to an increase in the asset's credit risk are not inconsistent with the respective business model. So there are times where an entity will be holding a group of financial assets for purposes of collecting contractual cash flows. And then they realize, oh, goodness, there's a debtor or there's debtors whose credit risk is increasing much more than what we would like to contend with. So let's sell these to manage our credit risk. The fact that you are selling these to manage your credit risk does not mean you're changing the business model. However, if more than an infrequent number of sales are made, so if you have more sales being made in the absence of an asset credit risk increasing, you as an entity would need to assess whether and how such sales are consistent with the business model. So if you have a group of financial assets, maybe you are a West Bank, you've got a number of debtors that owe you for motor vehicle finance, and their credit risk is not increasing. These people are still paying their debts on time. They are not appearing as though they are having financial struggles. So you're not at all concerned about whether you'll be able to collect the payments or not. But you start selling more and more of the debt over to a debt collection agency or whatever. Then you need to step back and say, am I still holding this portfolio of financial assets with the intention to collect contractual cash flows? Or have I now somehow crossed a Rubicon of sorts and I'm now starting to sell these over to whoever is willing to take them over? So you would need to reassess your business model. And one thing worth noting is that there is no threshold to the frequency or the value of sale. It's really just a matter of fact and judgment by management to determine whether the business model has changed or not. And at times, cash flows are realized in a way that is different from the entity's expectation. And this does not necessarily give rise to a prior period error. If the entity was holding these to collect contractual cash flows as opposed to selling them, and they realize that, oh no, we are now realizing the cash flows through sale more than we are through the collection of periodic payments, this does not mean that there is a prior period error in the financial statements or that there is now a need to change the classification of the remaining financial assets in the basket of the financial assets. So there are a number of business models, and we can break them down into three. The first business model is where you are holding financial assets to collect contractual cash flows. This is where the entity holds the financial assets to collect all or substantially all of the cash flows arising from the financial asset. However, it need not hold all of those instruments until maturity. So you could have a scenario where you are holding all of these financial assets or loans to collect payments from your debtors up until the end of the debt period or up until close to the debt period. In this portfolio, the selling of these financial assets is incidental to the business model, meaning you don't necessarily sell these as part of your business model. If it happens that, for instance, one or two debtors out of 100 debtors in the portfolio have an increase in their credit risk, and you decide, you know what, I'm not happy with the credit risk that I'm now being exposed to, let me sell off these two debts to a debt collection agency, then that is incidental to the business model. At the core of your business model, you are still holding this portfolio of financial assets to collect contractual cash flows up until the maturity of these financial instruments, or up until the debtors settle the debt altogether. Then there is another business model being a hybrid or dual intention business model where you are holding the financial assets to collect the contractual cash flows and to also sell. So we're not saying we're prioritizing the collection of cash flows over the sale. Both can happen at any time. The entities say whichever realizes a better cash flow position for us is what we'll go for. If in our assessment at the end of this year is collecting the cash flows from holding them is what's better, we're going to keep collecting them. But if there's an opportunity for us to realize better cash flows, then we're going to sell them. In that instance, the collection of contractual cash flows and the selling of these financial assets are both integral to achieving the objective of the business model, which is to maximize the cash flows. This model generally involves a greater frequency and value of sales. So the sales are not incidental to the business model. Here, if you have a portfolio of, say, 100 loans, you would have perhaps a high percentage of the loans being sold. Perhaps 60% of the loans are being sold, 70% of the loans are being sold, 30% are being collected up until maturity, or vice versa, because both the collection and the sale of these loans is integral to achieving the business model. Then we have another a category of business models called other. This could be a business model with the objective of realizing cash flows primarily through the sale of these assets. So you're not holding these financial assets to collect contractual cash flows. You're not holding these financial assets to collect and sell. No, you are actually just holding them to sell them. You give a loan to a customer and you then sell it over to a debt collection agency. We just categorize these as the other business model. Even though the entity will collect contractual cash flows while it is holding the financial asset, the collection of cash flows is incidental. For instance, you give out a loan today to a customer with the intention of selling it to a third-party debt collector. But the agreement between yourself and the third-party collector is taking, say, 4 months to conclude. In the 4 months, the debtor would still be paying you the monthly payments in terms of the loan. The collection of these monthly payments is, in this business model, incidental because the business model is to sell these off to the third-party debt collector. So the fact that you're going to sell it off to the third-party debt collector does not preclude you from collecting the contractual cash flows in the interim, because these are incidental by virtue of the nature of the loan itself. The loan terms will attract payments, and there will be interest and principal or interest on the principal amount outstanding that you are collecting on, say, a monthly basis, and you will still collect those, but the business model in this instance will still be to sell these off to a third-party debt collector. Any questions on this part before we move on? Okay. Let's take a quick question. Lecture example number 5. It says to us, CA Limited is a winter fashion retailer. CA Limited sells merchandise on credit and on a cash basis. 80% of its sales are on credit, meaning 20% of its sales are cash sales. In order to meet its liquidity needs and optimize its working capital cycle, i.e., in order to collect cash flows much more quicker, CA Limited established a new entity being SA Limited. And CA Limited is the sole shareholder of SA Limited. So CA Limited has now got a subsidiary called SA Limited. CA Limited has designated its subsidiary, SA Limited, as a financing house, and its sole purpose is to acquire the accounts receivable of CA Limited on a regular basis. That is, the funds to acquire these accounts receivable are raised through the issue of notes to external factors. What external investors? What this means is that the subsidiary, being CA Limited, will now buy the debtors book of CA Limited. So the subsidiary buys the debtors book from the parent entity. The interest on and the capital of the notes are serviced using the cash flows from the accounts receivable acquired. How does the subsidiary raise the money to buy the debtor's book? The subsidiary issues notes to external investors, and the external investors will then deposit money in the subsidiary. The subsidiary will buy the debtor's book from SA Limited, from CA Limited, and SA Limited will collect the contractual cash flows on the debtor's book. Having collected these, the cash flows will then be distributed to the holders of the notes. Notes are similar to bonds. You can think of bonds as notes. SA Limited monitors the credit quality of the accounts and evaluates the performance of the assets based on the interest revenue earned and credit losses realized. If payment is not made on a timely basis, the entity attempts to realize the cash flows through various means, including contacting the debtor by mail, telephone, and other methods. So simply put, ladies and gentlemen, we have CA Limited. They generate sales. 80% of the sales are on credit, 20% are on cash. The issue is not with the cash sales. The issue is with the credit sales. CA Limited wants to manage its working capital better. So what CA Limited does is it takes this debtor's book, which is made up of its 80% of credit sale, and sells it over to SA Limited. Once it is sold to SA Limited does everything under the sun to collect the debt outstanding. The required says we must discuss the nature of the business model of SA Limited, CA Limited, and the CA Limited Group. Here's the solution. The credit sales give rise to a financial asset, i.e., there is a contractual right to receive cash from customers. The financial assets are held to collect contractual cash flows until each financial asset is fully realized. This is evidenced by the entity making attempts to realize the cash flows through various means when payments are not made on a timely basis. Therefore, the business model of SA Limited, CA Limited, and the CA Limited Group is to hold the financial assets to collect contractual cash flows over the financing period of each credit sale. Because as soon as each credit sale is made, it is sold. The financial asset is sold to SA Limited. SA Limited then does everything it can to collect the contractual cash flows up until the debts are settled by the customers completely. So from SA Limited's perspective, the financial assets being the accounts receivables are held by SA Limited to collect contractual cash flows up until they are completely settled. Because SA Limited is a subsidiary of CA Limited, and together SA Limited and CA Limited are a group, it means that the group as a whole is holding these financial assets to collect the contractual cash flows over the financing period of each credit sale. Any questions? No questions. It's 8:15 on my watch. Can we take another 5-minute break and be back at 20 past?
Okay, ma'am.
Thank you. All right, ladies and gentlemen, are we back?
Yes, I'm back.
Okay. Okuhle, are we back?
Yes, sir, I'm back. I'm back. We can start.
Perfect. Please confirm that you are seeing the solution to lecture example number 5.
Yes.
Perfect. Thank you for the feedback. Okay, we've been talking about contractual cash flows up to so far, where we're saying in a business model where an entity is holding financial assets to collect contractual cash flows, and we've thrown the term around to say contractual cash flows, this and that. But what are we talking about when we talk about contractual cash flows? Think of yourselves when you take out, say, a loan with the bank. The bank will say, you have taken out a loan for 5 years or however many years. The interest rate is, say, prime -2, and you will make payments monthly or quarterly or however frequently. Those contractual, those payments that you're making are contractual payments in that they are specified in terms of how much they will be and how frequently they will be made, be it monthly, quarterly, annually. However, when we are now looking at the contractual cash flows that are made, we first need to then assess whether these meet the SPPI test. The SPPI test simply means that the payments that are made are solely payments of principal and interest on the principal amount outstanding. Meaning, these payments are payments that are made contractually, number one, but they are compensating the person who is owed the money for the time value of money, as well as the credit risk and other basic lending risks and costs that are associated with holding the financial asset for a particular period of time, as well as a profit margin. For instance, if you are a bank and you give out a loan to a customer, one of the first things you need to do is to check the affordability of the customer. When you check their affordability, you will look at their payment history that is reflected by their credit record. And having determined that, you will say, fine, this is a client whose risk is more or less okay. Therefore, we are going to attach an interest rate of 10%. And this is 10% on a loan of, say, 100,000 over 2 years. That 10% reflects the credit risk that the bank is exposed to. Credit risk being the risk that the borrower will not be able to settle the outstanding amount. So that interest rate will be compensating for the credit risk. It'll take into account the fact that this person has been lent 100,000 and is paying it off over 2 years, so the time value of money. And the bank is also looking to make a bit of a profit because it is the business of the bank to issue such loans. In that case, when the debtor is making monthly payments towards settling this loan, those payments are compensating for the time value of money. They're also settling the principal amount outstanding. So they would meet the SPPI test. These contractual cash flows sometimes would introduce exposure to risks that are unrelated to a basic lending arrangement, such as exposures to changes in equity or commodity prices. And these would then not give rise to contractual cash flows that are solely payments of principal and interest on the principal amount outstanding. So as soon as the interest is compensating for anything other than the risk associated with a basic lending arrangement, then you can't say the SPPI test has been met. If the SPPI test has not been met, then it means the contractual cash flows, being the monthly payments or annual payments, are not payments of principal and interest on the principal amount outstanding, where the principal amount is the fair value at initial recognition, which is subject to change due to the repayments over the loan term. Any misunderstandings or questions on this concept of SPPI? Just to make it clearer, if you are a lending institution and you say to me, David, we have 200,000 that we'd like to lend to you. Looking at your credit record, we think we can give you an interest rate of 12% per annum. You're going to settle this loan over 2 years. But if your profit increase to 15 million, you are then going to pay interest of 13%. In that instance, the interest rate that is attached to this loan is not purely attached to my credit risk, the credit risk attached to my credit profile. No, the interest rate is now linked to another performance measure. The fact that it's now linked to my profits or something else, something other than my credit risk, means when I now make payments, be it monthly or annually, towards settling this loan, I'm no longer going to be settling. The payments I'll be making will no longer be payments that are solely payments of principal and interest on the amount outstanding. No, they are payments of principal, interest on the principal amount outstanding, and another variable. So because there's another variable there, we cannot say the SPPI test is met. And this is important to us because the SPPI assessment informs the classification of our financial instruments or financial assets, and you will see shortly. When we now come to classifying our financial assets, the first thing that we need to start off with is to say, what is our business model? Is the business model to collect contractual cash flows? If the answer is yes, the business model is to collect contractual cash flows, we would move from the first, the block, the first maroon block on the top left, we would move vertically down. And the next question would be, are the contractual cash flows SPPI? Meaning, are they solely payments of principal and interest on the principal amount outstanding? If the contractual cash flows are solely payments of principal and interest, then the financial asset will be classified as being held in accordance with the amortized cost model as shown in the arrow going vertically down. Going back to our business model, if we say the business model is not to collect contractual cash flows, the next question becomes, is the business model to collect contractual cash flows and sell the asset? Meaning, do we have a dual intention in our business model? If the answer is yes, we go vertically down and then say, are the contractual cash flows solely payments of principal and interest? If the answer here is yes, then our financial assets will be held in accordance with the fair value through other comprehensive income model. Going back to the first block, we will still need to go back to say, is the business model to collect contractual cash flows? If the answer is no, then the question becomes, is the business model to collect contractual cash flows and sell assets? If the answer is no, then we go straight down to classifying our financial assets as being subsequently measured at fair value through P&L. And if the financial instrument is not held for trading and is an equity instrument, then it goes through fair value through OCI. So here, the last portion, the last on the far right, the two blocks, they are talking about financial assets that are equity instruments of another entity. So if you are holding shares of another entity, and you are not holding these shares to trade, then you would classify these shares as being held as at fair value through other comprehensive income. Any questions?
Yes, David, you mentioned
Yes.
something here when the profit increase, so the rate also will increase from 12% to 13%. Is it going to affect as well the period of payment?
No, it won't. It will only change the interest that is charged.
Okay.
So in that case, in the case where the business model is to collect contractual cash flows, in that same example that I gave, then we would say, yes, the business model is to collect contractual cash flows. The next question would be, are the cash flows solely payments of principal and interest on the principal amount outstanding? The answer would be a no. And that would immediately bring us to the fair value through profit or loss bucket of things. We wouldn't be able to go through fair value through OCI or anything or amortized cost. We would simply go straight to fair value through profit or loss because the contractual cash flows are for credit risk and something else. You know, that something else being my profit performance or some other variable. So always consider the SPPI test. The SPPI test will tell you whether you're going amortized cost or fair value through OCI. And you can only go to amortized cost if the business model is only to collect contractual cash flows. As soon as you are saying contractual cash flows and sale of these financial assets, you will have to consider fair value through OCI. And if the SPPI test is not met in that instance, anything that doesn't meet SPPI goes through fair value through profit or loss as a classification.
Thank you so
And
much.
you're most welcome. Then here's a quick schematic of how we measure financial assets. Let's start off with amortized cost. Looking at the column for amortized cost, at initial recognition, you recognize the financial asset when the entity becomes party to the contract. That is, when you agree, when the entity and the other party come to a meeting of minds and both parties agree to the terms of the contract. At initial recognition, the initial measurement will be at its fair value, which is the present value of the future cash flows, discounted at a market interest rate. The transaction cost, because it's at amortized cost, the transaction cost will be capitalized to the fair value. Interest will be included in P&L. Pardon me. Interest will be included in P&L. Impairment provisions you needn't worry about for purposes of your syllabus. There will not be any fair value adjustments to amortized cost assets. And when you derecognize the financial instrument, any difference goes to P&L. When we talk about financial instruments that are at fair value through OCI, and here we are talking financial instruments that are debt, meaning you have, as an entity, you've given out a loan to another entity, and you are now holding this loan to collect contractual cash flows. And the contractual cash flows are solely payments of principal and interest. So they meet the SPPI test. But your business model is not just to collect contractual cash flows. It is also to sell these financial assets. At initial recognition, once the entity becomes a party to the contract, you would recognize this financial asset at its fair value. The transaction costs would be capitalized to the fair value. You would still account for interest on it, meaning you would debit the financial asset, credit interest income. The impairment provisions we don't have to worry about. Fair value adjustments would then go through OCI, and gains and losses would have to be accounted for. Fair value adjustments would have to be accounted for, and you would have to reclassify the amount that's accumulated in OCI to P&L at derecognition date. Then when you are investing in shares, say you've bought shares from ShopRite or you've bought shares from Pick and Pay, wherever on the GSE, and you've decided you're going to measure these shares. You are not holding these shares to trade in them. Therefore, you have elected that you are going to remeasure the fair value movement in accordance with the through OCI. At initial recognition, you would recognize them at their fair value. You would capitalize transaction costs to the fair value. You would include any interest revenue from them in P&L, if any. Then the fair value movements would go through OCI. And on the disposal date, you would have to adjust the fair value and have your mark-to-market reserve. And at the end of when you sell these equity instruments, you could then recycle your mark-to-market reserve to retained income, or just keep it as is. And you'll see what we're talking about later on when we talk about a mark-to-market reserve in an example. And then you have fair value through P&L. With anything that's at fair value through P&L, again, initial recognition is at fair value. Transaction costs get expensed in P&L. If there's any interest, it goes through P&L. Fair value movements go through P&L. At the disposal date, you just determine the fair value adjustment and derecognize. Everything there goes through P&L. And here's a quick example of the financial of the journal entries. You can look at these in at your own leisure when you go through the lecture slides, but we are going to take examples just now just to show you how the financial instruments operate and the journal entries associated with them. Let's take a quick example here. Lecture example number 6. We're told CA Limited is a company that has a financial year end of 31 December. Information pertaining to an investment follows. On the 1st of January 2021, CA Limited invested in 10% bonds at their fair value of 10,000 Rand. The bonds will be repaid at a premium on their maturity date of 31 December 2024, and interest is payable annually at the end of the reporting period. The effective interest rate on the bonds is 15%. So the word bonds and debentures is used interchangeably across all spheres of finance. So when you come across a bond, think of it as a debenture. When you come across a debenture, think of it as a bond. We're told that on the 1st of January, there's an investment made at fair value. These bonds will be repaid at a premium. When they mature, the bonds are 10% bonds, and the effective interest rate is 15%. The required says we need to process all the journal entries in 2021, and we also need to prepare extracts from the statement of profit or loss and the statement of financial position for the year ended 31 December 2021. Let's look at the suggested solution. On the 1st of January 2021, we would debit an investment in bonds and credit our bank account with 10,000 Rand. Why? Because the 10,000 is the fair value of the bonds at that date. The example said to us here that they invested in 10% bonds at their fair value of 10,000 Rand. So at initial recognition, based off of this table of ours, we know that for every financial asset, when you initially measure it, you measure them at fair value. So because the scenario gave us a fair value of 10,000, we can comfortably say the debit to the investment is at 10,000, the credit is at 10,000 in the bank account. Then we are told that the interest rate on the bond is 15%, which means the bonds will attract interest at 15%. 15% of 10,000 is 1,500. So you will debit the investment in bonds with 1,500, credit interest income in the statement of profit or loss with 1,500. Then when the coupon payment is made, we're told that it's a 10% bond. And assuming that the fair value of the bonds is equal to the par value of the bonds, we can then say 10% of 10,000 is 1,000. So the payment would be into our account of 1,000, and there will be a credit entry to the investment in bonds account. This is us assuming that the bonds are held in accordance with the amortized cost model. That is to say, those payments of 1,000 Rand, those 10% payments, are for the principal amount outstanding and interest on the principal amount outstanding. They meet the SPPI test. Our extract would be as follows. In the statement of profit or loss on the 31st of December 2021, that should read 31st December 2021, apologies there. We would have profit before finance costs as an amount, and then we would have interest income in the statement of profit or loss. The interest income would be the 1,500 being 15% of the fair value, and the fair value we know was 10,000. Then coming to the statement of financial position, we would have a line item being under non-current assets. Why is it under non-current assets? Because the bonds are only going to be settled at the end of 2024. We are now reporting on the 31st of December 2021, which means we still have 3 more years up until they are settled. That makes them non-current assets, and the investment in the bonds would be sitting at the fair value of 10,000 at the beginning of the year, plus interest of 1,500, less the coupon payment of 10%, which then gives us a balance of 10,500. Any questions? No questions. Are you covered? Tabisa? Okushe?
Yes, I'm covered.
Quick question. The
Yes, sir.
coupon of 1,000, it will only affect the balance of the asset. Doesn't go to P&L.
No, it doesn't. So the coupon payment simply shows the actual cash that is received by us as the holder of the bond to reduce how much is still owed to us. So the coupon is the actual payment that we receive. And if you think about journal entries, it's simply a debit to the bank account. Why is the debtor paying us a coupon? The debtor is paying us a coupon to reduce how much they owe us. And how much they owe us is the investment line item that we have in our books. Making sense?
Yes, clear.
Happiness. Thank you. Let's now look at lecture example number 7, which deals with the fair value through profit or loss and OCI type of financial assets. CA Limited is a company with a financial year end of 31 December. We have information that pertains to the investments as follows. On the 1st of January 2021, the entity acquired 10,000 shares in a listed company at a total consideration of 500,000. The transaction costs amounting to 15,000 were paid. This is on the 1st of January 2021. 10,000 shares in a listed company, meaning whatever was paid was an amount that was reflected on the JSE or a stock exchange, which is the fair value of the share. Transaction costs amounting to 15,000 were paid. On the 1st of August 2021, CA Limited sold 800 of the shares in the listed company for 60 Rand per share. The fair value of the shares on the 31st of December 2021 was 520,000. The required said we need to process all the journal entries for the year ended 31 December 2021. Question becomes, okay, fine, we know that these are investments in shares. But if we have an investment in shares, we need to first consider the business model of these financial assets. If you make an investment in shares, they are a financial asset because they are an equity instrument that you are holding, being an equity instrument of another entity. Before we can do anything, we need to classify this financial asset. It can either be at fair value through P&L or fair value through OCI. It can be in fair value through P&L if we can demonstrate that we are holding them for trading purposes. If we are not holding them for trading purposes, they have to be at fair value through OCI. The information here, the fact pattern here is silent. So we have to make assumptions. The first assumption is that they are held in accordance with the fair value through profit or loss model. So the assumption is that the shares were held for short-term gains. At initial recognition, we would have to debit the investment in the shares in the statement of financial position, with 500,000 being what? The fair value of the shares. And we would credit our bank account with 500,000 because what we paid for the 10,000 shares, it's 10,000 shares, yes. What we paid for the 10,000 shares is an amount that is quoted on a stock exchange. These shares are listed. Because they are listed, the quoted price becomes the fair value. And because we are assuming they're held for short-term gains, they're going to be held in accordance with the fair value through profit or loss model. What we know there is that if it's at fair value through profit or loss, everything goes to P&L. The only thing that goes to the statement of financial position is the investment itself. The transaction cost of 15,000 that get paid on the 1st of January goes through P&L as an expense. So we would debit transaction cost with 15,000 and credit our bank account with 15,000. Fast forward to the date being the 1st of August 2021, when 800 shares are sold for 60 Rand per share. What we know is that 800 by 60 Rand, which gives us 48,000, is what is going to come into the bank account. We have 48,000 Rand coming into the bank account from the sale. Do we have a gain or a loss? That's what we need to determine. To determine whether we have a gain or a loss, we need to start off by saying, okay, we have sold 800 shares out of 10,000 shares. And what we paid for these shares, for all of 10,000 shares, was 500,000, which means the cost of the shares that were sold is 40,000. How we got to that 40,000 is we said, we paid a complete 500,000 for 10,000 shares. We've sold 800 shares out of 10,000. So 800 out of 10,000 multiplied by 500,000 gives us 40,000. That is the credit entry that goes against our investment in shares at the date on which the 800 shares are sold, and that's an amount of 40,000. The difference between what we got in the bank account and the cost becomes the gain on the sale of shares, and that gain goes to the statement of profit or loss as 8,000 Rand. Thereafter, we are told that at the end of the year, the fair value of the shares was 520,000. This therefore means that at the end of the year, because we are holding these financial assets in accordance with the fair value model through P&L, we need to say, fine, our carrying amount, what is our carrying amount on the 31st of December? Our carrying amount on the 31st of December is our initial investment of 500,000 less the 40,000 that was sold. That means our carrying amount is 500 less 40,000 is 460. But the fair value is 520, which means there's a difference of 60,000. And to bring our financial assets, being the investment, to 520,000, we would need to debit the investment in shares with 60,000 and then credit the fair value adjustment in profit or loss with 60,000. How we got to that 60,000 is we simply said the opening balance of 500,000 minus the value of the sold shares, which we determined as 40,000, plus or minus the fair value adjustment should give us 520 being the fair value of the shares at year end. Therefore, the fair value adjustment is 520 less the 500,000 plus the 40,000, which is 60,000 Rand. Any questions? Happiness.
Sorry, David.
Yes, sir.
I don't know if it's possible. Is it possible to go back to that slide, the measurement part?
Okay. This slide.
Yeah, this slide. Okay. So that example, we were dealing with the financial asset measured at fair value, not the amortized.
Through P&L.
Or through P&L.
Yes.
Okay. So if it was measured at amortized cost, we're not going to consider the fair value adjustment if at year end now we don't consider that part. It's not applicable.
Now, here's the thing. The nature of the investment. What is the investment? The investment is not the kind that attracts interest because it's share.
It's equity,
So because
wallet.
it's equity, it's an investment in equity, it cannot be at amortized cost.
Okay, so I know.
It's either going to be at fair value through OCI or fair value through P&L. And our assumption here was that the shares were held for short-term gains.
All right.
The opening line gives us the assumption that the shares were held for short-term gains. And if the shares were held for short-term gains, it is assumed that they are held for trading. So they are seen as stock to the entity. And if they are stock to the entity, think about a normal business. If a normal business sells pens, the cost of sales goes through P&L, the profit goes through P&L. Because the entity is holding these pens for short-term gains as inventory. The same applies with these financial instruments. If an entity is holding these shares for short-term gains, that means the cost should ultimately go through P&L and the gains should go through P&L. That's why then the gain on the sale is 8,000 here and the fair value adjustment goes through P&L to increase the cost of the investment. Is it clear?
Understood.
100%. Still with lecture example number 7. Here we're assuming that it's at fair value through OCI. The assumption is that the entity has made the election that is available, i.e. the entity elected to hold the financial asset in accordance with the fair value through OCI model. So if it's held in accordance with the fair value through OCI model, we would be sitting here in the second last column, where transaction costs are capitalized to the fair value and the fair value adjustments are going through OCI. What that means for us is the investment is still initially measured at its fair value. However, the transaction costs would get capitalized to the cost of the investment. The shares, the cost of the shares when they get sold is still the same. However, what changes is our fair value movement here. The fair value at the end of the year is still 520,000. To get to 520,000, we will need to say, what was the opening balance? The opening balance was 500,000 plus the transaction costs, less the 40,000 being the cost of the investment that has been sold, plus minus the fair value adjustments should give us 520,000. Therefore, the fair value adjustments become 45,000. Instead of the fair value adjustment going through P&L, it would go to a reserve in OCI. The reserve is known as the mark-to-market reserve in OCI. So this reserve is a separate reserve, quite like what you have. Remember with PE, we have a revaluation surplus going through OCI. This reserve for fair value through OCI is similar to that. It's a separate component of equity called the mark-to-market in OCI. And that's where the fair value movements would go to. Any questions?
No
Tabisa,
questions from my side.
You're awfully quiet. Are we still together, Tabisa?
Yes, David, I'm still in.
All right, happiness.
Yes.
Now we have classified, let's recap quickly before we move over to financial liabilities. We started off by saying we know the definitions of our financial instruments. We have now spoken to the classification of equity versus financial liabilities. We then hopped over to say, when we now have financial assets, we look at the business model. First of all, we look at the nature of the financial asset. Is it an equity instrument of another entity that we are holding? Is it, i.e., is it a share that we are holding? Or is it a debt instrument that we are holding? If it's a debt instrument that we are holding, we are entitled to payments from whoever is owing us the money. We then said, firstly, we need to look at the contractual cash flows to say, in a debt instrument, are the contractual cash flows solely payments of principal and interest? If they are, good and well. We then say, why are we holding this debt instrument? Are we holding it to collect these contractual cash flows that are solely payments of principal and interest? If the answer is yes, we are holding the financial asset to collect contractual cash flows, and the contractual cash flows are solely payments of principal and interest on the principal amount outstanding, we go amortized cost. If we have confirmed that we have cash flows that are solely payments of principal and interest on the principal amount outstanding, but we are holding these debt instruments in a business model where we want to collect contractual cash flows and sell as part of the objective of the business model, then it means that the financial assets will be classified as being at fair value through OCI. As soon as our contractual cash flows do not meet the SPPI test, everything goes to fair value through P&L. That is when we are dealing with debt instruments, that we are a holder thereof. Financial assets where we have a contractual right to payments. Coming to equity instruments, when we are holding shares in another company, we need to first of all say, the nature is that these are shares, and because these are shares, there are no contractual payments to this. Because there are no contractual payments, we don't even need to consider SPPI. We have two options. It's either we are holding these shares to trade in them, or we are holding them for long-term capital gain. We are hoping that in the long term, they will generate enough capitals for us. They'll generate enough capital appreciation, so to speak. If we are holding these for short-term gains, they have to be classified as going through fair value through P&L because they are akin to your trading stock. If they're your trading stock, you want to realize short-term gains. So you want to make profits in the short term. Every 3 months or so, you want to buy and sell, buy and sell, buy and sell. So the fair value movements would go through profit or loss because your overall profits for the business are dependent on how well you trade in these shares. However, if we are holding them with a long-term view in mind to realize long-term capital gains, we would then say, fine, we're not trading in these shares. We're holding them with the hope that over the long term, they'll generate a capital return. Therefore, the fair value movements would go through OCI in a separate account called mark-to-market reserve. So up to so far, we have talked about equity. Equity is not classified. We did say we never necessarily reclassify and remeasure equity. We have talked to the classification of financial assets. We now need to talk to the classification of financial liabilities, which is what we're going to do now. The standard says to us that the entity shall classify all financial liabilities as subsequently measured at amortized cost using the effective interest method, except for those financial liabilities that are at fair value through profit or loss. So all of your financial liabilities will all be subsequently measured at amortized cost, unless if the entity is holding these in terms of a model known as fair value through P&L. At initial recognition, an entity must measure a financial liability at its fair value minus transaction cost because every financial liability will be at amortized cost. Remember, for financial assets at amortized cost, it's initially measured at fair value plus transaction cost. Financial liabilities are the opposite of financial assets. So the financial liability will be measured at its fair value minus transaction cost. However, if the financial liability is designated at fair value through profit or loss, the transaction cost will be expensed rather than them being capitalized into the fair value of the financial liability. Similarly, remember, if a financial asset is held at amortized cost, at fair value, the transaction costs are expensed. If a financial asset is held at fair value, the transaction costs are expensed. If a financial liability is held or designated as being at fair value through profit or loss, the transaction costs are expensed. So they are mirroring each other. A financial asset that is held at fair value through P&L, the transaction costs are expensed. A financial liability at fair value through P&L, the transaction costs are expensed. In every other instance, transaction costs are capitalized, both for financial assets that are not at fair value through OCI, through P&L, I mean. If it's a fair value through P&L, it's expensed. In all other instances, capitalized. For financial liabilities, at P&L, transaction costs get expensed. Otherwise, they're capitalized. A gain or a loss on a financial liability that is measured at fair value shall be recognized in profit or loss, except in the case where the change in the fair value is attributable to a change in the credit risk of the issuer. You're never going to worry about instances where the credit risk of the issuer changes, so please do not concern yourselves about that. Again, this is just to demonstrate the financial liabilities. Please read through these slides at your leisure. We're going to take examples to demonstrate these. Lecture example number 8. We've got CA Limited, a company with a financial year of 31 December. On the 1st of January, they issued 10,000, 9%, 100 Rand debentures at their fair value. The debentures are redeemable on the 31st of December 2024 at their par value. Transaction costs amounting to 25,000 Rand were incurred. On the 1st of January 2021, the market-related interest rate on debentures with a similar risk profile was 12% per annum. So what this tells us is there are 10,000 debentures that have been issued. And if the entity has issued debentures, it means the entity has received an amount of money. So there's an amount of money that's gone into the bank account for 10,000 debentures, and 9% has to be paid. So 9%, and it becomes 9% of what? 9% of the 100 Rand. The 100 Rand is the par value of the debenture. So 9% of 100 Rand per debenture, and there are 10,000 debentures, is what is the annual payment. We get told that these debentures were issued at their fair value, meaning the amount of money that went into the bank account is equal to the fair value. We were not told what the fair value is. That we were not told. But because we're given the market-related interest of 12% per annum, we can determine what the fair value is. What becomes tricky is the fact that there are now these transaction costs that have been incurred. And given the bit of information that we're sitting with here, it's clear, because these are debentures and the scenario is silent on whether there's a designation at fair value through P&L, because the scenario does not say we have designated these as being at fair value through P&L, it means that they are going to be at amortized cost, because all financial liabilities are classified as being at amortized cost unless they're designated as being at fair value through P&L. Because they're not designated, it has to be at amortized cost. The required says prepare all the necessary journal entries for the year ended 31 December 2021. To do this, we're going to perform a bit of a gymnastic. Please bear with me. The first step is to calculate the fair value of the debentures. What we know is that the number of periods is 4, because these were issued on the 1st of January 2021, and we are told that they are redeemable on the 31st of December 2024 at their par value, which means it's a period of 4 years. From 1st January 2021 to 31 December 2021 is 1 year, to 31 December 2022 is 2 years, 31 December 2023, 3 years, 31 December 2024, when they get redeemed, is 4 years. So we have 4 periods. The payment is 9% of the coupon of 100 Rand. So 9% multiplied, so 9% of the par value. So the coupon is 9% of 100 Rand being the par value, multiplied by 10,000 of these. That gives us 90,000 Rand as the payment. The future value, being FV in our calculation, is the 1 million. How did we calculate the 1 million? To get to the 1 million, we said 10,000 multiplied by 100 Rand, because they are going to be redeemed at their par value in future. Their par value is 100 Rand and there are 10,000 of them. That's the future value. The interest rate that we're going to use is 12% because it's the market-related interest rate. The market-related interest rate gives us what? The fair value, being the present value of these debentures. The present value is 908,879,052 cents. Now, because these are held at amortized cost, we need to subtract the transaction costs from the fair value in step one. To do that, we simply say the fair value is 908 less the transaction costs, which means the carrying amount of the debentures is 883,879. Having recalculated the carrying amount of the debentures at initial recognition, we can then calculate the effective interest rate in our financial calculator. So we change the PV to 883,000. And then we let our financial calculator determine the interest rate. The interest rate changes to 12.9%. The effective interest rate is what we will then use to determine the interest for the year. What we would then do is, in preparing our journal entries, we would say what came to the bank account is 908,879, because the scenario told us that these debentures were issued at their fair value. The fair value we determined, ladies and gentlemen, to be this 908,000. So we would debit our bank account with the 908,000, credit our debenture liability in the statement of financial position. Then, having paid the transaction cost of 25,000, we would need to subtract them from the debenture liability. Remember, the debenture liability is a credit balance. Us subtracting the transaction costs and essentially capitalizing them, we would have to debit the debenture liability with 25,000 Rand. This debit entry is what then brings us to the amount of 883,879 being the carrying amount on the 1st of January 2021. Having then determined the effective interest rate, we will then take the 883,000 and multiply it by 12.9%. That gives us the interest expense for the year. Debit interest expense, which gives us 117,000. The interest expense increases our debenture liability by 117. At the end of the year, we have a coupon payment of 90,000, which reduces our bank account and reduces the debenture liability. I'm going to pause here for questions. Tabisa, Ogushe, are we covered?
Yes, David, I'm fine.
Are you 100% sure?
Because now I was just thinking about this transaction cost, but now after this journal, no, I'm fine.
Okay. Are you comfortable with how we get to the 908,000?
Yes, I'm comfortable. I'm fine with that. But
Are you also? Oh,
but now,
sorry.
if this transaction it was through P&L financial statement, while it was fair value through P&L. How we were going to treat this transaction cost? We're going to minus from the above calculation, or what?
We weren't. All that we were going to do, if this was at fair value through P&L, this journal entry here wouldn't touch our debenture liability. We would just have debit transaction cost in P&L, credit the bank account, which means that the 12% interest here would be the effective interest rate.
Oh, okay.
So the carrying amount of the debenture on the 1st of January would be just 908,879.
Okay. Okay, David.
So the fact that we capitalize the transaction cost affects it changes our effective interest rate. It increases the effective interest rate, and because the effective interest rate is increased, then our interest expense becomes higher than what is being paid as a coupon payment.
Thank you so much.
Great. Ogushe, are you covered?
Yes, I'm covered because I had the same issue as Tabisa in terms of the transaction cost. If they are capitalized, meaning there won't be any time value of money affected. So
So as soon as you capitalize the transaction costs, guys, please remember one thing. The capitalization of your transaction costs creates a scenario where the effective interest rate is different from the market-related interest rate. You therefore need to always recalculate the effective interest rate because you've capitalized the transaction costs. Are you comfortable with that? Because in determining the present value, the fair value of the instrument, we used 12%. The moment the carrying amount, the moment we capitalize the transaction cost, it means the interest rate which was used to determine the present value needs to change because our present value has essentially changed from 908,879 to 883 because of the transaction cost. Therefore, our effective interest rate needs to be recalculated. This is the 12% is the market-related interest rate. The market-related interest rate gives us the fair value. Once we have the fair value and we capitalize transaction costs, the effective interest rate that is going to go into our amortization schedule changes. And we need to then use our financial calculator to determine it. In our example, we determined it to be 12.9, and that's the amount or that's the rate that we are going to be using to determine the interest expense that is going to be capitalized year on year on the financial liability. All clear?
Yes, David, thank you.
Thank you so much, Tabisa, for the feedback. Thank you, Ogushe. All right, the compound financial instruments example, we covered this, ladies and gentlemen. We covered it earlier on where we said, first things first, we calculated the fair value of the liability component. We determined it to be 1,095,000. And we know that the carrying amount was 1.2 million. That's how much came into the bank account. Having calculated the fair value of the liability component, we were left with the equity component. This then gave us this journal entry of ours. We then accounted for interest on the liability component only because we don't account for interest on the equity component. And the payment, the coupon payments, go against the debenture liability component only. Then I think finally we have derivative financial instruments, which we spoke about. When we spoke about derivative financial instruments, we said generally a derivative has the following characteristics. Its value changes in response to changes in the underlying item. It requires little or no initial investment, and it is settled at a future date. These are the characteristics of a derivative. For purposes of your objective test and ultimately your big assessment, you need to be aware of the following examples of derivative financial instruments. So with a derivative financial instrument, it derives its value from the value of an underlying asset, a price, a rate, or an index. And the types of instruments that we get that are derivative financial instruments include a forward contract. A forward contract creates the obligation to buy or to sell a defined amount of a specific underlying asset at a specific price at a specific future date. So for example, if you are I'm imagining a truck, a logistics company, you could enter into a forward contract to buy a barrel of diesel for your trucks at a defined amount on a specified date at a specified price. So you could say, you could approach BP or Shell or engine to say, listen, I'd like to get into a forward contract. In terms of the forward contract, I want to buy a specified, a defined amount, being a barrel of what? Of diesel at 10,000 Rand in 3 months' time. So 3 months from today. So because you've entered into a contract and you are obligated by virtue of entering into this contract to buy a defined amount. The defined amount is a barrel of a specific underlying asset, being diesel, at 10,000 Rand, being a specific price, at a specified future date, which could be April, May, June, July, 24th of July. That is a forward contract. It's created an obligation on you to buy that amount of, that quantity of what do you call this, of diesel. Now, just to demonstrate to you why we say a derivative derives its value from the value of the underlying asset. If you've committed to buying this 10 barrels at 10,000 Rand, and the price of each barrel in the interim, in the 3-month period, if the price of a barrel moves up to say 11,000, you are better off because you have locked the price. You know that the price, someone who does not have this contract, you have entered into a contract with BP. Someone who doesn't have a contract with BP would currently have to pay 11,000. You have a contract that entitles you to only pay 10,000, which means the value of your contract is 1,000 Rand per barrel. You are better off by 1,000 Rand compared to, say, a David who's out there who doesn't have a forward contract. On the other hand, if people in the market are buying a barrel for 8,000 Rand and you are committed to buying a barrel for 10,000, you are worse off by 2,000. So the value of this contract that you've entered into is derived from the market value of the underlying, being the barrel of diesel. On the other hand, you have futures contracts. Futures contracts create the obligation to buy or sell a standard quantity of a specific underlying item at a specific future date, specified future date. So this is where you would simply say, I'm going to buy a barrel in 3 months' time. That's a futures contract. Here, you have not specified, a defined amount or a specific price or anything. You've just specified a standard quantity and you've specified a future date. So you've committed yourself to buying a barrel of diesel in 3 months' time. Then you have option contracts, being options. These create the right. They only create the right, but not the obligation to buy or to sell a specific underlying asset at a specific price on or before a specified future date. So it's on or before a certain date. Here, it could be an option to buy or sell shares, an option to buy or sell diesel, an option to buy or sell currency at a specified price, being the exercise price, on or before a certain date. So again, if you have entered into an option to buy a liter of diesel for 10 Rand a liter, then you'd say the option period is 3 months. If the price per liter of diesel goes up, you will be in the money, which means someone who does not have the option will buy it at 20 Rand, while you can buy it at an exercise price of 10 Rand. The value of your option contract lies in the fact that you have this benefit of buying it at a cheaper price. However, if someone in the market can buy a liter for 5 Rand and the option gives you the option to buy it at 10 Rand, you will say, I'm not obligated to exercise at 10 Rand, so I will not use my option contract. Instead, I will go buy the liter like everyone else in the market at 5 Rand instead of presenting the option contract. The only time you would present the option contract is if it's in the money. If David is out in the market buying a liter of petrol, a liter of diesel for 20 Rand, and you have an option contract that allows you to buy it for 10 Rand, you're going to go as an option holder to say, hi BP, I have this option that I entered into. I see that it's in the money because everyone in the market is buying diesel for 20 Rand. I'd like to exercise my option and my right to buy it at 10 Rand. Then you have forward rate agreements as a type of derivative financial instrument. These are contracts where you fix the interest charge on a floating rate loan. So a forward rate agreement is where you like simply saying, I would like to fix the interest charge on a floating rate loan because I don't want to be exposed to fluctuations in the interest rate. I want to peg my interest. If I'm taking out a loan with Standard Bank, I'd like to peg it at 10% instead of having it at prime plus something or prime minus something, because then the interest rate will float as soon as there is a change in the prime rate, it'll go up or down. Then an interest swap is an agreement where you exchange periodic payments at specified intervals over a specified time period. Swaps can be interest rate or currency swaps. So with swaps, for instance, these periodic payments that we're talking about could be ones where you enter into a loan agreement. And in terms of the loan agreement, you've agreed that you are going to pay ABSA or whoever has lent you money, interest payment on interest that is floating. You borrow 100,000, the interest on it is prime plus 2. Because the interest is prime plus 2, the payments that you make will be influenced by the interest. As soon as the repo rate goes up, it will then push the prime rate to go up, which will make your payments go up. I, on the other hand, then go to ABSA and I say, ABSA, I also want to borrow the same amount of money as, say, for instance, Tabitha has borrowed, but I want to pay a fixed interest rate. ABSA gives it to me and I get an interest rate of 10%. We could then decide that we are going to swap, where the payment that you make to ABSA, I have to pay you that payment, and you then pay me the payment that you have to make to ABSA. That then ensures that you are hedged against the exposure to the variability in the variable interest rate, and I then get exposed to a variable interest rate as opposed to a fixed interest rate. And that is as far as you need to understand with these different types of derivative financial instruments.
Sorry, David, can you please come again with swap rate? You are saying what?
Okay, so with the swap, let's agree that you and
Yes.
you take out a loan with ABSA.
Yeah.
The loan is linked to the prime rate, right?
Yes.
The loan term does not change. You've entered into a loan for 5 years and it's at prime plus 2%.
Yes.
Do you agree with me that if you've entered into this loan for 5 years, if at any point in time the repo rate goes up, the prime rate is also going to respond and go up?
Go up, yeah.
Which means because the payment term, the period has not changed, it means now your payments, your monthly payments are going to go higher.
Yeah.
I, on the other hand, let's say I go to Standard Bank and I borrow money and I say, Standard Bank, here, I want a fixed interest rate. You have
After
borrowed for 100.
increase.
No.
Okay.
On the same date, you
All
borrow
right.
100,000 from ABSA and it's prime linked. I go to Standard Bank and I say, Standard Bank, I would like to borrow 100,000 Rand for 5 years. And Standard Bank says, fine, if you want an interest rate that is floating, we'll give you prime plus 2%. And then I say, no, I don't want a floating interest rate. I want a fixed interest rate. Standard Bank is going to say, okay, if prime plus 2% is about 13, for argument's sake, if they say it's 13, they're going to say over the 5 years, the prime rate might go up and we still want a profit. So we are going to charge you, David, 16% as a fixed interest rate.
Oh, yeah.
That interest rate that I'll be paying Standard Bank is going to be higher than what you pay ABSA, agreed,
Yes.
you would be paying, say, 13% on that floating interest rate. I'll be paying 16%. And let's say I then realize, oh, shit, the repo rate is not going high. And 2 years into this, the repo rate goes high, but I'm still paying an interest rate that is higher than what I would have paid on the, what do you call this? On the, if I had opted for a floating rate.
Yeah.
And you then say, you know what, David, actually, I don't like the fact that in 1 year I'm paying interest of X amount, and as soon as the repo rate goes up,
Increase
my
and
payments,
then
I
also-
don't want that. I don't want that fluctuation of interest rates. Let's swap. What that means is essentially you and I are swapping interest to say the fixed interest rate that I pay, the difference I pay over to you, and you pay over what you pay to me. So we are swapping interest rates to ensure that you are paying a fixed interest rate because you don't want volatility in your statement of profit or loss. I am happy to have the volatility and the exposure to the change in repo rates. So in essence, whatever you pay to ABSA, I pay it over to you. And whatever I pay to Standard Bank, you pay over to me.
Okay, I get it.
So we're
Because I
swapping
always
interest.
confuse this. Yeah.
Yeah, we're swapping interest.
I always confuse this because I thought maybe you will pay. I will pay the difference, and then you will also remain on 15%. Like I was just confused, but now I get it.
It's literally just exchanging interest rates to say you now get, because we have the exact same amount. The notional amount is equal.
Yeah.
Except I now pay you the fixed interest rate. You pay me the variable interest rate. So you will owe me the variable interest rate. I will owe you the fixed interest rate, which means that in essence, you would pay ABSA the variable. I pay you the fixed. The net is what is the net that you are talking about now.
Oh, okay.
And equally, I will pay Standard Bank the fixed. You will pay me the variable. And the difference between the fixed and the net is what I am either benefiting or losing on.
Okay, thank you so much, David.
Great. And that, ladies and gentlemen, concludes our financial instruments lecture. Now, for purposes of your assessments, as you indicated, Tabisa, you will have multiple choice questions to choose from. It's important to understand the underlying principles for you to be able to pick the correct answers in the test or in your assignment. So that is why we had to go through all of this. But remember this, with the CIMA qualification, ultimately, the idea is to make decisions. It's for decision making. So always think, what is the strategy of the entity? What is the risk appetite of the entity? To speak to how or the kind of instruments that the entity that is subject of your case study, the instruments that they should get into, always think along the lines of the strategy of the entity. If the entity is risk averse, you would want it to get into instruments that are more stable, that don't expose it to fluctuations in interest rates and the like. If it is an entity that has a big risk appetite, then you can have it go into financial instruments that are volatile, that go through P&L, etc., etc. So always think of, yes, classification, yes, SPPI, all of these things, but equally think of the impact on the statements. If you have financial assets going through P&L and financial liabilities going through P&L, it means year on year, your profits are going to fluctuate because of these. Is the business having the appetite for this? Is this aligning with the strategy of the business? On the other hand, if you have financial assets that are at amortized cost and you have financial liabilities at amortized cost, then again, there's a level of stability because you can predict the interest that is going to be charged on financial liabilities. You can predict the interest that's on financial assets. The transaction costs get capitalized. They don't touch on P&L. Your profit or loss is not, your profit or loss is not volatile, but the transaction costs then result in a bigger asset on your statement of financial assets. They result in a lower financial liability. So it has implications on your liquidity, on your solvency ratios. You're going to need to do, to think along all of those lines, which is why I think one of the final topics you should be covering is ratio analysis to see how all of these accounting standards ultimately come into your financial statement and the implications they have on your multiple ratios. And that will then help you inform the decisions of the business. But it's equally important for us to understand the backdrop, the classifications, the measurements, etc. And looking at convertible, for instance, your convertible pref shares to say, if this entity is considering issuing a pref share that is convertible, would it be advisable for the pref share to be convertible at the option of the holder or at the option of the entity? If it's at the option of the holder, it means there's a financial liability that is going to be recognized. And if there's a financial liability that's recognized, you are loading the liabilities of the entity, which impacts on the liquidity and solvency ratio. So you need to think broadly about these things. It's not just the debits and the credits. Think about what they make the financial statements to look like. With that, I would like to end it here and also just invite you guys to please make use of the sessions that have been set aside for consultations. I look forward to consulting with you guys. I'm excited, in fact, to engage with you guys on a one-on-one level, just helping you unpack the different topics and just help you navigate your way through the questions that you have. Thank you so much for your participation this evening, and have yourselves a great evening further.
Thank you so much, David.
Thank you, Thabisa. Thank you. Thank you, Ogushe.
Thank you, David. Bye-bye.
Thank you. Cheers. Oswald, thank you so much for sticking through this entire session with us.
No worries, man. I'm always here. Catch you on the next one.
Catch you on the next one. I think I'm coming through only in June. But yeah, thank you so much.
No worries, man. Good night.
Good night.